Hello, welcome back to class. And today we'll be talking about budgetary control and responsibility accounting, budgetary control and responsibility accounting. And when we talk about that, we'll be discussing on the meaning and objective of budgeting. We also look at the types of budget. We look at preparation of master budget and then responsibility center and performance evaluation. What is budget? Let's form an analogy. Planning, are you planning a road trip and you decide your destination, which is a goal, you map out your route, which is planned, and you estimate your fuel, your food, and hotel cost, which is budget. And so also it happens in terms of business. Now, understanding the meaning of budget is very, very important when we talk about business. And a budget is a quantitative plan for future period, experiencing strategic goal in financial terms, like naira or in some other currency, or physical term, like units to produce. And it's not just about spreadsheet, it's just about you forming a figure in a spreadsheet. It's about it being a management tool that helps with one planning. It talks about where do we want to go, control, are we on the right track, coordination, which is talking about is everybody working together, and then motivation, talking about does the team have clear targets. And when we talk about this, it's actually important to look at why we need budget. Just like we said, it's actually the very first thing is for planning. And first, it's actually budget forces managers to look ahead and set clear, measurable goals. Also, it's the reason why we need budget is because to be able to ensure all departments work together to be able to achieve the common goal of an organization. Also, it's needed for to clearly tell everyone in the organization what the target and expectations are, which deals with communication. As per the control, budgets act as a benchmark, and by comparing actual results to the budget, managers can see where things went wrong or right and take corrective measures. And as per the resource allocation, it helps decide where to spend limited money, material, and manpower for the best results. And as per the performance evaluation, budget is needed to be able to provide a fair basis for access to assess how well a department or manager has performed. Now let's look at the types of budget. We have a number of them. The first we'll be looking at is fixed budget. And when we say fixed budget, it is set for one specific level of activity and does not change. And it has an advantage of being simple to prepare and a disadvantage of useless for control if actual activity level changes. And an example that is a budget based on producing 10,000 units is irrelevant if you only produce 8,000 units. And another one is the flexible budget. And for this is a smart budget that adjusts to different level of activities in terms of 70%, 80%, 90% capacity. And the advantage of this kind of budget is that it provides a realistic benchmark for performance evaluation, especially when production fluctuates. Also, it has a disadvantage of it being more complex to prepare. And now looking at these two, flexible budgets are superior for control and performance evaluation in most real-world business where activity level changes. So it is it's actually a realistic benchmark, and it allows for adjustment. Other ones are cash budget, and cash budget estimates all expected cash inflow and outflow over a specified period of time to ensure that the organization maintain adequate liquidity to meet the obligation. Sorry, excuse me. And talking about the sales budget is the starting point of the budgeting. It is the starting point of the budgeting and its process, and it represents the organization's plan for expected sales during a specified period, expressed in both quantity and value. We also have the production budget, which talks about the estimation of the number of units to be produced during a period to meet sales demand and maintain desired inventory level. We have the material budget, which outlines the quantity and cost of raw materials required for production. We also have the labor budget, talking about the total labor hour and cost required to achieve the planned level of production. We have the overhead budget, which deals with all indirect estimation of all indirect costs associated with production, administration, and selling and distribution activities. And for the master budget, it's actually the final comprehensive plan that combines all the individual budgets into a budgeted income statement and a balance sheet. And in preparing the master budget, the preparation is a systematic and sequential process which involves several steps as explained below. The first one is to set objective and assumption, that is, you define financial goals and establish key planning assumptions about market conditions and costs. Also, you prepare the functional budget, that is, you create departmental budgets starting with sales, then production, material, labor, and overhead budget. Also, the next step is to review and coordinate, that is, ensuring all departments' budget aligns are realistic through committee review and adjustments. And the next is create financial statements. That is, you consolidate all budgets into the budgeted income statement and budgeted balance sheet. And the next step is to obtain approval and implementation. That is, you get formal management approval and distribute the budget as official performance targets. And the last one is monitor and revise. And this talks about a continuous comparison of actual results to the budget and making adjustment as needed. We have what we call the responsibility center. And when we talk about the responsibility center, it is actually a segment or units of an organization such as a department, division, or project whose manager is responsible for controlling certain costs, revenue, or assets. And each center operates within defined boundary and has measurable objective consistent with the organization's overall goal. And the type of responsibility center are the cost center. And for this, a manager is responsible for controlling and minimizing costs, but is not accountable for generating revenue as seen in the production or HR department. And we also have the revenue center, where a manager is responsible for generating the sales revenue, but does not control the cost of the production, the product sold or major investments, as it is the case of the sales department. We have the profit center, and for this, the manager is responsible for both the revenue and cost, and is therefore accountable for the profitability of a semi-autonomous unit like the standalone bank branch or the restaurant in a chain. We also have the investment center as the last one, which the manager is responsible for profit and has the authority to manage the asset and investments used to earn it, with performance measured by metrics like return on investment, as seen in the full subsidiary company. In conclusion, budgetary control provides the plan and the benchmark for performance. Responsibility accounting provides a framework for accountability and evaluation, and together they turn strategy into actions, empower managers and motivate employees, ensure every part of the organization is pulling in the same direction, and then create a system of continuous feedback and improvement. This partnership is essential for management control and long-term success. Thank you for joining.